The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, of course, is a certified financial planner at Galileo Capital. 25 minutes now to 8. Okay, so I have a question for you. Not for you, Warren. I'm going to get your view for the next little while. But I have a question for you who's listening to this, which is, are you one of those people who wants to go out and get your money to make you as wealthy as possible? In other words, you want your money to work for you. You're willing to risk it a little bit, not all of it, but a little bit. And you want it to actually do things and become more productive. Or are you one of those people who actually just need to be able to sleep at night? To be able to sleep at night, I need to know that it's safe, that nothing can happen to it, that it's not going to be invested with Steinhoff or something like that. And therefore, it's not going to work that much. It'll kind of just keep you where you are. Where do you sit on that spectrum? I mean, most of us are somewhere on the spectrum. And I have a sub-question for you, and I'd really like to hear your view on this. Are you different on that spectrum in terms of risk from where you were 20 years ago? If you were at all working, earning, thinking 20 years ago, were you, I want it to be perfectly safe? Or were you, I'm happy to risk it all? Where have you moved? Where do you think you're moving to? Which end? Tonight we're talking about guaranteed investments or market investments. Warren, good evening. I suppose the word and the definition that we need to look at is the word guaranteed in a guaranteed investment.
Yeah, it sounds like such an obvious thing to explain, but actually a lot of people get confused by this because when we talk about a guaranteed investment, it's usually going to be one of two things. It's either going to be the income or the interest that you generate from the investment, or the capital that you've put into the investment. So one of those two things will be guaranteed. So let's just say we can use the government, the RSA retail savings bonds as an example. What they do is they say to you, give us your money for 2 years and we're going to pay you, just as an example, 7% interest a year. And at the end of the 2 years, you're going to get your capital back and you're going to have earned 7% interest a year. So the guarantee there is government saying to you, we're going to give you this interest and it's going to be paid to you, and you don't have to worry about anything else. You don't have to worry about stock markets, bond markets, property markets, or the weather. None of that matters to you. You just know your money's coming back. So that would be the one option. Or the other option is that you put the money into something where you hope to get a return. And if things go well, maybe you get more than your capital back. But if things go terribly, what happens is the guarantee says, we'll give you, if you put in $500,000 and we all thought the world was going to do incredibly well and it didn't go well, then you're going to get back your $500,000. So no return is guaranteed, no interest is guaranteed, but your capital is guaranteed. So that's the meaning of guarantee when we talk about these things. So usually one or the other, Stephen.
Okay, so what would be a guaranteed investment? I mean, just sticking it in the bank is a guaranteed investment.
Yeah, so the bank will, the idea there is that you probably have no risk of capital. So you're not going to lose capital unless the bank goes bankrupt. And in South Africa, that has happened in the past. But what happens then is that the Reserve Bank steps in to make sure that the people who put their money with the bank are protected, either that the Reserve Bank honors those guarantees, or the Reserve Bank gets another bank to buy the bank and you're fine. So usually what happens with a bank is it'll be something like a fixed deposit where the bank guarantees an interest rate to you. And so that would be the one option. Or for example, you buy a product from an investment company or an insurance company where they say, give us your money for 3 years or for 5 years, and we're going to try and give you the return of a portion of the stock market. But if it doesn't work, we'll give you back your capital after the 3 or the 5 years.
Okay, when someone is providing the certainty, I mean, they're not doing it as a favor to you. So how are they then making money out of that?
They make money in one of two ways. So let's talk about a guaranteed interest rate. So if you invest in the bank of Warren Ingram, I take your money and I say to you, Stephen, okay, I'm going to give you 5% a year interest guaranteed. You don't have to worry for the next 5 years. You're going to get 5% a year. I take that money and I go and I lend it to someone else. and I charge them 11% because they want to buy a car. And so that difference between the interest I'm paying you and the interest I'm charging someone else is the money that I make. It's my profit. And so what happens for me is that I make quite a bit of money, a healthy margin off you and off the person that I've taken where I've taken your money and I've lent it on. And the thing there is that often that interest rate that you're earning is quite a lot lower than you could do elsewhere. So that's the one option. The market, the kind of capital guarantee option where we say, okay, let's invest in the ABC capital guaranteed investment, and we're going to link it to the performance of the NASDAQ index in America. So that sounds amazing because everyone's been talking about tech all the time for the last 2 years, and it's all we ever hear about. But now someone's offering me a capital guarantee for investing this money. So it sounds amazing, but the catch is I'm going to say to you, well, if your investment does more than 10% a year, whatever growth you get above 10%, that's mine. So if the investment actually grows at 30% a year, you're going to get 10 and I'm going to get 20 on your money. Oh, and by the way, if the whole thing halves, for example, then this whole guarantee is null and void. And sorry about that. Then you're going to get back whatever capital there is. So you might actually not have a real guarantee at all. You might have a guarantee for certain circumstances, but when the world really falls apart, then all of a sudden the T's and C's kick in, and you actually end up losing a fair amount. So you're kind of not too good to be true. This is not a scam, but the thing where you think, well, I'm going to get the return of the tech index and everything's going to be fine if it doesn't go well. Unfortunately, if it goes horribly, you might actually end up in kind of a pickle.
Okay, so you're getting peace of mind, but there is a cost to it.
Horrible cost, because on the one side, you're sacrificing either a lot of growth or you're locking in an interest rate. And the thing about the interest rate is you're locking in certainty. So you're saying, okay, I'm going to get 7% a year. That's fantastic. I don't have to lose any sleep anymore. My investment will only ever give me 7%. It's a nice interest rate. The thing you forget then is that there is this thing called inflation. So the cost of living is going to go against you. And our friends at SARS also want a portion of the interest that you're going to earn because we pay tax on interest. And so that certainty comes at probably a below inflation return after costs, after taxes. And so now, you take inflation into account and you might well be going backwards, even though you never saw a cent of loss in any one day on your investment. So I feel, actually these things are really expensive. And if we talk about a stock market related guarantee, most of those stock market related guarantees are for terms of 3 to 5 years. Now, the reality is, there are very few times in history where if you put your money into the stock market and you leave it there for 5 years, there are very, very few times where you don't get back at least your original capital. There have been instances, there are a few, not many, but in most instances, leaving it there for 5 years and almost certainly leaving it there for 10 years would mean that you're going to get back your capital and some growth. And you're not sacrificing any of the upside. You're not sacrificing any of the dividends that you earn. All you need to do is just let it do its job. So the certainty for me comes at a tremendous cost.
Okay. Then a market-linked investment, which, we sort of talk about quite often, I suppose, is you put your money into things on the market.
Yeah, and there are a couple of these options. So for example, I want to jump to retirement because that's one where it appeals, certainty can appeal to a lot of people. So you would say, well, I'm going to buy certainty in my retirement funds. Now, the alternative to that is you buy a living annuity, which you can decide that actually I'm going to take a portion of my money and it's going to be in a money market account, a portion is going to be in the bond market, and the balance is going to be in the stock market. And I'm going to do that in local and global investments. And then your living annuity growth is going to be whatever all of those markets are doing at the time. So there's no promise on a growth rate. There's no promise on a capital guarantee. What you are getting is whatever the markets have given you. Alternatively, you could just do a normal investment where you you buy something that's a unit trust or an exchange traded fund or shares or government bonds or properties, anything, what you own then is the investment itself and the performance that gives you, or potentially the losses when those come. So the idea of a market-linked investment is when the going is good, life is great and you feel like the top of the world. But in a bad year, when the markets fall, suddenly you don't feel so clever, and it becomes a little bit more scary because there are no promises, there is no certainty, and you could be looking at your statements and they're underwater, for a period of 1, 2, or even 3 years, and that happens quite regularly. So for a lot of people, that becomes kind of worrying and a little bit sickening, actually.
I can imagine, but in the end, over 10 and 20-year periods, I mean, that really is the way to go, and historically that. It seems almost you can't really get away from that. That's almost a certain historical fact.
Yeah, our problem here is that a lot of people psychologically are almost addicted to certainty. We wake up in the morning and the first thing we do is we check our weather app on our phone, even though rationally we know it's probably a 50-50 chance that the app's going to be right. Or we listen to forecasts from clever economists who tell us what the rand's going to do in 12 months' time, even though history tells us that they can't get the direction right. More than half the economists will be wrong about where the rand's going to be in 12 months from now. And we can go through forecasts of interest rates. The last time the Reserve Bank met, everyone thought that interest rates would go up, and they didn't. So we value all these forecasts because we want certainty, but the problem is there is no certainty, and very often the unexpected happens quite a bit. And that uncertainty and the instability that comes from investing and global geopolitics and all the things that impact the prices of your investments, that uncertainty is the very thing that gives you the chance of generating good capital growth over long periods of time. But we're not wired for that. We don't like that as human beings. We want to know that the sun will rise tomorrow and our investments will go up. And so that finding a way to deal with the uncertainty, people look at a guarantee as maybe the thing that will save them from everything.
Okay, so a guarantee, there's a real cost to it. Are you able to work out what that cost is?
Yeah, let's look at something where you lock in a rate of 7% a year, and that sounds like a pretty decent rate if they're talking about, maybe inflation will only be 3 or 3.5% a year, and someone says to you, well, I'll give you double that, and we'll put it in a 5-year fixed deposit. How does that sound? And you say, well, okay, let me take 500,000 rand, and I'm going to put that in the 7% a year fixed deposit. The balance I'm going to put into kind of a well-spread, well-diversified, the magic D word, diversification, well-spread, well-diversified portfolio that's got no guarantees, but it's going to be invested in a mix of cash, bonds, property, shares. Going to do that in South Africa and overseas. Historically, that kind of investment, if we look at what's happened over the last 20 or 30 years, it averages around 10% a year. So the one is going to give you a guarantee of 7% a year, no volatility, no losing sleep. The other one's going to give you an average of 10. But what's going to happen is that 10 is going to come in kind of a real roller coaster ride where you're going to get 20% up 1 year, 15% down the next, 5% all the way along. But over time, averages out at 10%. If you then look at those two investments after 5 years, the guarantee will probably be at around about 700,000, actually 701. So you put in 500,000, you've now made another 201,000 Rand for taking no risk. That's what's now in the bank, literally. Whereas the market-linked one, with all the roller coaster rides, has given you about 805,000. So the difference is just over 100,000 Rand. And for some people, Stephen, they're going to say, well, hang on, to lock in a guarantee for a 5-year period and not have to lose sleep, I'm only sacrificing around 104,000 Rand. I'll take that deal. But then let's zoom out a little bit further. Now we go for 20 years, which is kind of a normal investment period for most of us. That's what we're going to do for the majority of our capital accumulation years in our careers. Suddenly, your 500,000 Rand, when you've got a guarantee, turns into 1.9 million. You feel like a hero because you think you've done well. But your market-linked investment, your 500,000, has turned into 3.4 million Rand. And suddenly we're looking at a huge difference. That's the difference between comfortable retirement and a really difficult, tricky retirement.
Yeah, that's a huge difference from, 1.9 to 3.4 is massive. All right, we have a question for you, Warren. It comes from Bongani. Bongani says, I recently bought a house. I have a bond. I have an emergency fund. It covers my expenses for 6 months. Someone said I should transfer the money to my bond instead of earning interest. Is this a good idea? Interesting to consider that. Bongani will have an answer for you in a moment. It's 9 minutes late.
The Money Show. Personal Finance with Warren Ingram.
8 minutes to 8. Warren Bongani's question. I have a house, I have a bond, I've got an emergency fund. It covers my expenses for 6 months. Should I put that money into my bond instead of just leaving it on the side earning interest? Warren, what do you think? I mean, where would it get the best return?
Yeah, I love that question. So just to think about the likelihood is you're probably around, earning somewhere between 5 to 7% a year on your emergency fund. And that's good because it's compounding in your favor and the money's instantly accessible. But if we look at a bond, most people are probably paying prime or prime minus one. We don't know what Bongani's paying. But that's considerably higher than the interest that you can earn on your emergency fund. So for me, the storing your emergency fund money in your bond makes a lot of sense. The second thing is you don't pay tax on the interest that you're saving from your mortgage. In other words, if you're paying prime and actually now you put in extra money there and now you're paying a bit less at the rate of prime, that's saving you don't get taxed on. Whereas the money that you've got your emergency fund, you might be paying tax on the interest. So for me, I love the idea of storing money in the bond as my emergency fund. Just make sure that it's accessible. That don't think that 19 years into the bond that you might be able to draw that extra money out. You might not be able to. So just make sure that it's always accessible. Maybe just do a little test run first to see that you can draw the money out, because you're going to need this in an emergency, not when you have time to negotiate with the bank. And then just make sure that you maintain the discipline of keep paying extra money into the bond. Don't forget that emergency fund money is not just a bond repayment; it's your emergency money.
Yeah, no, that makes sense. You've got to be disciplined about these things. But once you become disciplined, I suppose it's quite easy. When you talk about a guaranteed investment, I suppose the question is it really as safe as it might feel? I mean, you get sold all of these things on advertising, but does it really live up to the word guarantee?
Well, let's jump back to the example I did. So you get your guaranteed return of 7%, but suddenly you find out that inflation is running at 3.5%, maybe up to 5%, depending on the time, and then maybe there are some costs to pay, and don't forget that if it's a fixed deposit, you've also got some tax on the interest. So what you realize then is you've been earning this money; it's been growing in your favor. But after 5 years, if you go and value what you can buy with it, and you compare that to kind of a trolley full of groceries, unfortunately, that trolley full of groceries after 5 years is going to be a bit less than what you could buy 5 years before. And so that and we're talking about the buying power of your money. So locking in guarantees where you get the certainty can actually be enormously expensive. And I'm not saying all guaranteed investments are terrible all the time. That's not true. But the moment you're kind of going in the 5-year period or even longer, and you're getting fairly low returns, I think you've got to be very, very careful about the cost of certainty. It could be the most expensive investment you ever make.
I suppose you've got to work out what you're trying to achieve, and what you're trying to achieve is you're trying to beat inflation.
Yeah, that for me is the silent killer of investments. We focus on the noise of markets going up and down, and oil prices and political crises and wars and all of those things. But actually, we don't really get that sort of big bell ringing at us to say, the cost of living just went against you over the last 3 months, and watch out. And to me, kind of good stock market and market related investments have a very good history over nearly kind of 120 years of beating inflation, if you give it time and you get through the rocky, uncomfortable periods.
Okay, then. So under what circumstances does a guarantee make sense? And I started this by asking, is there maybe something to do with age?
I mean, for some people, there might be the need to kind of lock some money away, and they're elderly and they don't want the volatility. I can see some kind of a benefit to that, but I think time frame is maybe a little bit of an indicator. In other words, you've got kids that are in high school, and you know with certainty that at the end of high school you're going to have to pay for university, and so you want to know that university cost is covered. And you've only got 3 years left before they go to university. You can't afford to kind of have a time frame where stock markets are going down at the time where the university says it's time to cough up. In which case, locking money into, let's say, a 2 or 3 year guarantee, whether it's a fixed deposit or some kind of a guaranteed investment, that makes sense to me. Or you've got a plan to buy a house, and you want to put down the deposit, and then locking in a guarantee on that kind of a time frame makes sense. So when you know that there is a fairly short period of time, whether it's 30 days up to maybe 3 years, where you're going to need that money and you're going to have to pay a fixed amount on a particular day, then suddenly guarantees become a lot more sensible to me, because you need the certainty not to deal with volatility or your own emotional discomfort. You need it to pay for a fixed cost. So that for me is when I think guarantees are incredibly valuable. But for older people who are retired, who just don't want the volatility of investments, maybe the only thing I would say is that it might be worth looking at a guaranteed annuity. So instead of taking a living annuity, maybe you get some quotes on what you could get on a guaranteed income from your annuity. That might be the one time. They call them a life annuity or guaranteed annuity or pension. That might make some sense. But beyond that, if you're one of those people that just can't deal with volatility, and every time the market goes down, you sell and panic, maybe looking at a guarantee for a portion of your investments would make sense.
Yeah, that does make sense to me. Warren, thank you. I really do appreciate it. I found that really, really interesting. Someone in your life probably might be thinking of a decision like this. You might well want to send them to the podcast here. Warren Ingram, thank you. The co-founder at Galileo Capital, as always, bringing some wisdom at this time on a Tuesday. But yeah, as I say, someone maybe even just in your street WhatsApp group needs to hear this conversation around guaranteed investments and market investments.